Taxes are an essential part of our economy. After all, that is the only way the government is going to get the funds with which they have to serve the public. A funny thing about taxes is that each individual is taxed differently, even investors. In fact, investors are taxed in different ways, and you need to know the distinctions between each one, as this can mean the differences between IRS audits and potential criminal implications, and saving the maximum on your taxes. Hello and welcome back to the channel. I'm Isaac, your personal finance nurse, and I specialize in helping nurses and healthcare workers achieve optimal financial health through simple and detailed finance education. Although you may be a nurse or healthcare worker by trade, many of you actually qualify as an investor even if all you have is a 401k. And if you own a piece of property or invest in stocks on the side, you definitely are a full-blown investor. So you'll definitely want to watch this video all the way through, as I'll be covering the most common forms of taxes for investors. Without further ado, let's get into it. So what is an investor? An investor is a person or other entity who invests money in the hope of reaping a profit. Different financial instruments are used by investors to make a return and achieve essential financial goals, such as establishing retirement savings, supporting a college education, or just collecting extra wealth over time. Stocks, bonds, commodities, mutual funds, exchange-traded funds or ETFs, options, futures, foreign currency, gold, silver, retirement plans, and real estate are just some of the investment vehicles available to achieve goals. Investors can look at possibilities from a variety of perspectives, but most aim to limit risk while increasing rewards. But one thing is certain: when an investor decides to put his money into something, he or she is thinking about the long-term benefit that they can derive from that investment. Now, moving on to how these investors are taxed. Well, each investment is taxed differently, and we're going to tell you about 5 common ones so that you can get an idea of how taxation works. The first tax category we will cover is taxes on dividends. Dividends are generally taxed in the year that they are received. You must declare a dividend even if you didn't get it in cash, for example, if it was automatically reinvested to acquire more shares of the underlying company, as in a dividend reinvestment plan or DRIP. Dividends are divided into 2 categories: non-qualified and qualified. Non-qualified dividends are taxed at the same rate as your ordinary income tax bracket. Qualified dividends are typically taxed at a reduced rate. Depending on your taxable income and filing status, you'll pay 0%, 15%, or 20%. Your broker or any company that issued you at least $10 in dividends and other distributions will send you a Form 1099 Div or a Schedule K-1 after the end of the year. The 1099 Div shows how much you were paid and whether or not the dividends were eligible. Now, there are ways to minimize this. Dividends from assets held for a particular amount of time may be eligible for a reduced tax rate. Remembering to save money aside for dividend taxes might help you avoid a liquidity crunch when the tax bill arrives, but keeping dividend-producing investments in a retirement account can help you avoid paying taxes on your investments. Next up is 401k taxes. In general, you don't pay taxes on the money you put into a regular 401k, and you don't pay taxes on investment gains, interest, or dividends while the money is in the account. Only when you remove money are you subject to taxes. You pay the taxes upfront with a Roth 401k, but your eligible payouts in retirement are tax-free. The money you remove from a typical 401k is taxed as regular income, like income from a job in the year you take the distribution. If you take money out of a standard 401k before turning 59 and a half, you might face a 10% penalty on top of your taxes unless you qualify for one of the exceptions. If you wait too long to make withdrawals, you may be charged a penalty after age 72. Don't think anyone is going to wait that long though. The next category is mutual funds. Taxes on dividends and capital gains when owning mutual fund shares, as well as capital gains taxes upon selling the fund shares, are common. The investments in your mutual fund may earn and distribute dividends, interest, or capital gains. As a result, even if you haven't sold any of the shares or receive any cash from them, you may owe taxes on them. The tax rate you pay is determined by the sort of mutual fund distribution you get, as well as other criteria. You may be subject to capital gains tax if you sell your mutual fund shares for a profit. Now, how can you reduce taxation on this? If you wait at least a year before selling your stock, you may be able to reduce your capital gains tax rate. Holding mutual fund shares in a retirement account may help you avoid paying taxes on the interest, dividends, and gains that your mutual fund pays out. Other methods include tax loss harvesting and investing in funds that are less likely to deliver taxable revenue. Now, I know for a fact that some of you viewing this video right now might own a house. Maybe you took advantage of this really hot housing market and decided to put your property up for sale. Some of the gains from the sale of your house may be taxed. If you're single, the IRS usually allows you to deduct up to $250,000 in capital gains from your principal residence and up to $500,000 if you're married and filing jointly. Assume you and your spouse purchased a property for $200,000 10 years ago and sold it for $800,000. If you file your taxes jointly, $500,000 of your gain may not be subject to capital gains tax, but $100,000 might be. The rate that you pay on the remaining $100,000 is determined in part by your income and filing status. The final form of taxation we're going to talk about is the tax on capital gains. Now, what are capital gains? A capital gain occurs when you sell a capital asset for more than its initial acquisition price. Stocks, bonds, precious metals, jewelry, and real estate are all examples of capital assets. The amount of capital gains tax you'll pay is determined by how long you own the asset before selling it. Long-term capital gains are taxed differently than short-term capital gains. When selling an item, it's critical to consider capital gains taxes, especially if you participate in online day trading. To begin with, any earnings you make are taxed. Second, while you may have heard that capital gains are treated more favorably than other sorts of income, this isn't necessarily true. Now, let us tell you about the key difference between these two forms of gains. A short-term capital gain occurs when an asset is sold after being owned for 1 year or less. While long-term capital gains are typically taxed at a lower rate than pay or wages, short-term profits are not eligible for any tax breaks. They are subject to ordinary income taxation. Short-term profits are subject to whichever marginal income tax rate you fall into as a regular taxable income. Now, there are several federal tax brackets in the United States with rates ranging from 10% to 37%. Your adjusted basis is an asset used to calculate net capital gains. That's the price you pay for an asset less depreciation, plus any costs incurred during the asset sale and any modifications you made. If you receive an asset as a gift, you inherit the donor's basis. The tax on a long-term capital gain is usually consistently lower than the tax on a gain realized in less than a year if the same asset is sold. Because long-term capital gains are taxed at a lower rate than short-term capital gains, owning assets for a year or more can help you reduce your capital gains tax. Now, moving on to the tax rates, we're going to discuss the long-term capital gains tax first. The tax treatment of long-term capital gains altered with the passing of the Tax Cuts and Jobs Act. Prior to 2018, the tax brackets for long-term capital gains and income tax brackets were nearly identical. Long-term capital gains tax rates were introduced under the TCJA. These figures fluctuate from year to year. Now, the rates vary according to filing status. For example, single individuals have to pay 0% up to $41,675, but they will pay 20% on any amount above $459,750. But if they are head of a household, then that amount is increased to 0% up to $55,800 and 20% for over $488,500. The benefits only grow if you're married and file your taxes together. So if you guys needed any more motivation to get married, this is it. Now, moving to short-term capital gains taxes. As we mentioned earlier, short-term capital gains are treated as regular income and are taxed accordingly. You must include any income from assets that you held for less than a year in your taxable income for that year. For example, if your taxable income from your salary is $80,000 and your taxable income from short-term investments is $10,000, your total taxable income is $90,000. Short-term capital gains are taxed according to the same tax brackets as ordinary income. Ordinary income is taxed at different rates based on how much money you make, and a short-term capital gain, or at least a portion of one, may be taxed at a higher rate than your ordinary income. This is because a part of your overall income may be shifted into a higher marginal tax rate. Now, you may be wondering about state taxes. Well, whether you must also pay capital gains taxes to the state is determined by where you live. Capital gains are taxed in certain states, whereas others have no preferential treatment for them. Some states do not have any income taxes, include Nevada, Alaska, Florida, Texas, and a couple of others. A credit, deduction, or exclusion is available in some states. For example, Colorado provides a real or physical property exclusion, whereas New Mexico provides a deduction for federally taxable profits. Montana includes a credit that can be used to offset some of the capital gains tax. Long-term capital gains sound really nice now, don't they? If you hang on to an asset for more than a year, you'll get a big tax advantage. For example, consider an investor with a taxable income of $75,000 per year. In January 2021, they purchased 100 shares of stock. Here's what happens if they sell during the first year of ownership versus afterwards. So they bought a stock for $1,000 and added to that brokerage commission of $50. The adjusted basis comes out to $1,050. They managed to sell the stocks for around $6,000. They make a profit of around $5,000. Now, with the short-term capital gains tax of 22%, they will have to pay $1,100 in taxes. If they had waited for more than a year, then they would have been taxed at 15%, which means a tax of only $750. This isn't to say that holding an investment for a short period of time isn't beneficial. Prices aren't set in stone, of course. Our example is hypothetical, and it's doubtful that someone could actually make the same profit before taxes on an item at various times. The value of things like stocks or Bitcoin can fluctuate dramatically. Some investors make a living by executing calculated trades that entail regular buying and selling. It's also worth noting that the net investment income tax, or NIIT, applies to both short and long-term capital gains. You may owe an extra 3.8% net investment income tax if your adjusted gross income exceeds $200,000 as a single filer or $250,000 as a joint filer, regardless of whether your gain is short or long-term. The first stage in calculating your capital gains tax is to distinguish between short and long-term investments. Remember that the tax is based on your net gain. Therefore, factor in any capital losses. A tax specialist or financial advisor may assist you in calculating your capital gains tax and devising measures to reduce or eliminate it in the future. Investors have a variety of options when it comes to earning a neat profit, but there is always a catch, whether it is dividend income, a long-term gains, or even the profit derived from a sale of an asset like a house. But the only difference between all these vehicles is the tax rate and the time of your investment. Take the example of a 401k. Your eligible payouts after retirement are tax-free, but if you take out the money before a certain age, you have to pay a 10% penalty on top of tax. Now, coming to long-term capital gains and short-term capital gains, obviously, if you're a regular investor, then keeping your investment for the long term might seem like the wiser choice. But sometimes prices fluctuate, and you might even end up losing money because you get a little greedy about the tax rate savings. In the end, it all depends on your financial goals and the level of time and commitment you're willing to put into your investment. But overall, long-term gains seem to be the right way forward for most passive investors, as getting thrown into a higher income tax bracket just because of a little profit does not seem that fair. Anyways, that's all the time we had for today. I hope you guys really enjoyed this video, and don't forget to subscribe to the channel and hit the bell icon on your way out. I look forward to seeing you on the next video. Peace.